Imagine you wake up on a Tuesday morning in 1989, an ordinary Tuesday, the kind where nothing feels different, where the coffee tastes the same and the news on the radio is background noise. And somewhere between breakfast and the front door, you check the mail. There is a letter, official envelope, the name of your savings and loan in the top left corner, the institution where you have kept your money for 11 years, the place your father recommended when you got your first real job. The place that felt, in the way that certain institutions feel, permanent. You open it. And in the careful legal language that institutions use when they want to tell you something devastating without using a single human word, the letter informs you that your savings and loan association has been seized by federal regulators, that your deposits above the insured threshold are subject to review, that the process may take months, that you should not expect full recovery. You read it 3 times because the first 2 times, your brain simply refuses to process what your eyes are seeing. Everything you saved, the years of discipline, the vacations you didn't take, the car you didn't buy, the slow and patient accumulation of a life lived carefully, is gone. Not stolen in the night, not lost in a fire, gone through a process that was legal, that was approved, that was in many cases encouraged by the very government that is now sending you this letter and asking for your patience. This happened to 23,000 people because of one man, and it happened to millions more because of a system that was specifically designed, not accidentally, not through negligence, but deliberately and methodically, to make sure that when the losses came, they would land on people exactly like you. This is the story of the savings and loan crisis. And the reason you need to understand it is not because it is history, it is because it is a blueprint. One that has been used before, used again, and is being used right now. And the only people it doesn't work on are the ones who can see it coming. To understand how the system broke, you first need to understand what it was built to do. Because the original design was not just functional, it was almost elegant in its simplicity. Savings and loan associations, sometimes called thrifts, were created in the 1930s in the aftermath of the Great Depression, specifically to solve a problem that had become a national crisis. Ordinary Americans could not get mortgages. Commercial banks weren't interested in 30-year home loans. The math didn't work for them. So Congress created a separate category of institution, purpose-built for exactly one thing, taking deposits from working families and turning them into home loans for other working families. The model was deliberately constrained. These institutions could pay depositors somewhere between 5 and 6% interest. They would then lend that money out as 30-year fixed mortgages at 7 to 8%. The spread, that 1 to 2% gap, covered operating costs and generated modest, reliable profit. No speculation, no complexity, no gambling with other people's money on instruments nobody fully understood. Between 1950 and 1970, this system helped finance the construction of tens of millions of homes. It was one of the primary mechanisms behind the creation of the American middle class as a physical, geographical reality. The suburbs, the neighborhoods, the places where a factory worker could own a house and send his children to a school 3 blocks away. It was boring in the way that good infrastructure is boring, invisible when it works, catastrophic when it doesn't, and for 30 years it worked. Then inflation arrived, and it didn't arrive quietly. By 1979, inflation in the United States had reached 11.3%. By 1980, it hit 13.5%. The highest in the post-war era. The Federal Reserve, under Chairman Paul Volcker, made the decision to kill it through one of the most aggressive monetary tightening campaigns in American history, raising the federal funds rate to nearly 20% by June of 1981. It worked. Inflation broke, but the treatment very nearly killed the patient along with the disease. Because savings and loan associations were now caught in a trap that had no clean exit. On one side, their assets. 30-year mortgages locked in at 7 and 8%. Loans they couldn't call back, loans that would sit on their books for decades, generating the same modest return they always had. On the other side, their liabilities. Depositors who could now walk across the street and put their money into a money market fund earning 15, 16, sometimes 18%, which is exactly what they did. Between 1980 and 1982, savings and loan associations across the country watched their deposit base erode in ways that the system had never been designed to handle. The deregulation came in two waves, and each wave was presented as a solution, while actually functioning as an accelerant. There was a third change, quieter than the others, that received almost no public attention at the time, but would prove to be the most consequential of all. Deposit insurance was raised from $40,000 to $100,000 per account. On its face, this sounded like consumer protection, and it was sold as exactly that. In reality, it was the removal of the single most powerful check on reckless behavior in the entire system. Because as long as depositors knew their money was guaranteed by the federal government, regardless of what the institution did with it, they had absolutely no incentive to ask questions, no incentive to choose carefully, no incentive to move their money when they saw signs of trouble. The discipline that informed depositors could theoretically impose on badly managed institutions. The discipline of withdrawal, of reputation, of market consequence was completely eliminated. What remained was a system with a logic so perverse it would be almost admirable if the consequences weren't so devastating. Institutions could take unlimited risks with depositor money, knowing that if those risks paid off, the profits belonged to shareholders and management, and if those risks failed, the losses belonged to the American taxpayer. Economists have a term for this: moral hazard. The condition that exists when one party takes risk because they know someone else will bear the cost of failure. But moral hazard as an academic concept doesn't quite capture what this was in practice. What this was in practice was an open invitation, backed by federal guarantee and political protection, to take depositor money, swing for the fences, and walk away clean if it didn't work out. And the people running these institutions were not slow to understand the invitation. What followed was not a wave of bad luck or miscalculation. It was, in a significant number of cases, organized theft, conducted inside federally insured institutions under the noses of regulators whose capacity for oversight had been deliberately degraded. At the same time, the institutions were being given expanded powers to do damage. The schemes were varied, but the underlying logic was consistent. A savings and loan would extend a large loan, often to a developer with personal connections to management, often for a project whose valuation was fraudulent from the start. The developer would use part of the loan to pay fees back to the institution or to individuals within it, creating the appearance of income. The project would be carried on the books at inflated value, making the institution look healthier than it was. Auditors, where they existed, were often the same firms doing business with the institution they were supposed to be examining. Regulators were understaffed, underfunded, and in some cases actively pressured to look elsewhere. No case illustrated this more completely or more painfully than Charles Keating and Lincoln Savings and Loan. Charles Keating acquired Lincoln Savings and Loan of Irvine, California in 1984 for $51 million. Within 2 years, he had transformed it almost beyond recognition. The safe, conservative mortgage portfolio that Lincoln had maintained for decades was systematically replaced with high-risk investments: commercial real estate in Arizona, junk bonds issued by Michael Milken's Drexel Burnham Lambert, speculative development projects in the desert outside Phoenix with names like the Phoenician Resort, which Keating built at a cost of $300 million, and which was, by any rational analysis, never going to generate returns sufficient to justify its cost. But the investment strategy, reckless as it was not the most important part of what Keating did. The most important part, the part that kept the whole structure standing for 4 years longer than it should have, was the political infrastructure he built around it. The criminal referral was delayed. Lincoln continued operating for 2 more years, taking in more deposits, making more bad bets, paying Keating and his associates millions in salary and bonuses, while the hole in its balance sheet grew from roughly $300 million to over $3 billion. When Lincoln finally failed in April 1989, it was the single most expensive thrift failure in American history to that point. The federal government paid out $2.6 billion to insured depositors, but more than $250 million in bonds that Keating had sold directly to Lincoln customers, many of them elderly retirees who had been told by branch employees that the bonds were as safe as federally insured deposits, which they were not, which they had never been, were simply gone. 23,000 people, average age over 60, average loss between $20,000 and $200, 000. People who had done everything right, people who had saved carefully and trusted the institutions their government told them were safe. Keating was eventually convicted on 73 counts of fraud and racketeering. He served 4.5 years in federal prison before his convictions were overturned on procedural grounds. The Phoenician Resort still stands in Scottsdale, Arizona. It is currently operated as a luxury hotel. Room rates start at around $600 per night. The final accounting of the savings and loan crisis took years to complete, and the numbers even now have a quality of unreality about them. To put that in context, this was the largest government bailout of a private industry in American history as a percentage of GDP at the time, larger than the combined bank bailouts of 2008 on a relative basis, larger than any single corporate rescue before or since. The entire cost was borne by the public, not by the shareholders who profited during the expansion years, not by the executives who collected bonuses while the institutions rotted beneath them, not by the senators who ran interference for the operators, by the public, by the people who had nothing to do with any of it, who were simply living their lives in an economy whose foundations were being quietly hollowed out. And almost nobody remembers it, because that is the part that matters most. This was not an accident. It was not a unique convergence of circumstances unlikely to recur. It was a structure, a specific, repeatable architecture of incentives and protections that produces the same outcome every time it is assembled, regardless of the decade, regardless of the instruments involved, regardless of the names on the door. The structure is always the same. Deregulation that expands the capacity for risk without expanding the consequences of failure. Government guarantees that remove market discipline from the people whose discipline matters most. Political relationships that slow regulatory response at precisely the moment when speed is the only thing that limits the damage. And then, at the end, when the losses are too large to hide and too real to defer, a transfer. Quiet, legal, laundered through the language of systemic necessity and public interest. The losses move from the balance sheets of private institutions to the accounts of people who never benefited from the upside and had no voice in any of the decisions that produced the downside. The question is never whether the system is efficient. The question is who designed the incentives, who benefits when the risks pay off, and who is standing at the mailbox on a Tuesday morning when they don't. 23,000 people opened a letter and lost everything because one man understood that in a system built the way this one was built, the protection matters more than the investment. Because in a system where the downside is always someone else's problem, the rational move is always to take more risk, build more political cover, and move faster than the regulators can follow. The people who designed that system knew what they were building. The people who operate inside it today know what they are operating. The only variable, the only thing that has ever changed the outcome, is how many people outside it understand the blueprint well enough to see it being assembled before the letter arrives.